Hello and welcome to this live programme from Baillie Gifford, the latest in a series of webinars where we talk to the managers of the business's different investment trusts. Today we're talking to Iain McCombie, co-manager of the Baillie Gifford UK Growth Trust. So welcome Iain, thanks for joining me today.
Hi Amy, good to see you.
So let's begin. This is the UK Growth Trust. We're sitting here in the UK where stocks have kind of lagged their global peers for some time now. Many would consider this kind of discount as a reflection of the growth and innovation on offer here. But how are you turning this scepticism to your advantage?
Yeah, it's a good question, Amy. I mean, I think the first thing is that actually UK markets performance has actually been improving. And I think actually that's because it's starting to reflect the fundamentals. And despite what you might always hear about the UK, there are innovative companies and there's some really good news stories. You know, a great example of that, one of our biggest holdings is Games Workshop, which I think is people think is a niche business, it's a kind of hobby business, and yet actually it's a very rich IP business, very high margins, a really attractive growth potential. It's actually going to go into the FTSE 100 now, which is pretty amazing when you think about it. And there's opportunities for it to continue to expand its addressable market. It's just signed a deal with Amazon to potentially for Amazon to develop a TV series for some of its characters, and it's got 30 years plus of very rich IP, which is really exciting, and I think that can only be good news for the company.
So I suppose that's an example of holding a stock from its small beginnings, humble beginnings, right through to its listing, and how your relationship with that is a journey, I suppose.
Absolutely, and I think that as a growth investor, that's what you want. You want to move that shift from whether it's small or medium to becoming FTSE 100 companies. That to me is success, and why we're long term in our nature. We've got relatively long term holding periods because we want to turn that advantage of hopefully businesses that are growing at a faster rate. You want to own them for as long as possible. So that's really our style.
And is that sort of a small to mid caps of sector a really fruitful hunting ground for you?
Yeah, I think for us, not just for the UK team at Baillie Gifford, but Baillie Gifford more generally, we've always liked this area because it's a law of, I call it small numbers, that it's much easier to double or when you're say a £3 billion company rather than you're a £30 billion company. Now, obviously, there are a few, particularly the US, big tech companies that have been able to do that. But if you look at history, they're the exception, not the rule. Where you get the really sweet spot, I think, is finding those businesses like Games Workshop that a lot of people never heard of or kind of think it's a bit of a silly game. And actually, when you do your due diligence and actually see what's going on there and get to know the management team that are doing a fantastic job there, then you can really see why that business got a really long-term growth runway.
Okay, so our first point is really about how the UK stock market has been deeply unfashionable for some time now. Another big issue I suppose to contend with is the issue of investment trust discounts. The industry is waking up to it, and in many instances taking steps to reduce the discount, such as buying back shares. At Baillie Gifford, along with the continuation vote last year, you've made an announcement to keep the discount to single digits. So do you want to talk to me a little bit about this dynamic and how this is playing out?
Yeah, well, I think the first thing, Amy, is there's a great advantage of investment trusts, and I know there's a lot of people making noise at the moment that investment trusts don't make sense, and I disagree with that. I think one of the first advantages of an investment trust is you've got an independent board of directors that are there to try and look after the interests of all shareholders. So to what you're saying there in terms of discounts and buybacks, our board recently put out an announcement that said that they want to keep the discount at a single digit rate. So I think it's kind of sending that message to the market that we don't want the discount to drift out, and we're not going to do anything about it. So we've been upping our buyback to ensure that the discount is remaining at that level. But it's not just discounts or buybacks. It's also kind of longer term points. And as you said, we have a continuation vote every 5 years. It passed last year. But we also said, we're going to have a one-off continuation vote in 29, that if we don't outperform over that 5 years, we will give shareholders the option of 100% of their money back, less costs, roughly. And also we're going to have a one-off vote in 2027 to the same extent. So I think that's an example where the board are acting, listening to shareholders, are trying to do what they think is the right thing. And myself, Milena, my co-manager of the trust, we're fully behind that. We think it's absolutely fair for shareholders to have those rights to vote in it. So I think that's an example where the investment trust structure really works for shareholders.
And in terms of the discount, as an investor, that can be advantageous.
Yeah, well, if you're a buyer, Amy, you can buy, 90p of you can buy £1 of assets. So that I think that's really attractive. That's, I've always been an investment trust buyer for, 30 plus years, because I think that's a really attractive, function of it. Though obviously what you have to have is a board that want to manage, I think, the discount. And that's when, as you hinted, that's something that I think the industry has to keep looking at, to kind of make sure that we don't let discounts drift out to kind of perhaps too high levels. But I think as the UK Growth Board, Growth Trust Board have done, is demonstrate what they think is the right thing at the time for shareholders, and I think it's a great option.
And just to stay on this point for a little bit longer, because I think our audience is going to be interested. Of course, this is the big news is the US hedge fund Saba Capital. It's all over kind of trade press and national press. So it's developed an activist strategy that's seen it take advantage of the near record discounts in the price of investment trusts. So it's looking to force through board level changes. Now, 6 of the 7 trusts, shareholders have voted against the proposals, and the last of the 7 UK investment trusts targeted, which is Edinburgh Worldwide, that votes this Friday. So can you spend a few moments giving us your take on this, I suppose, drama in the investment trust sector, and perhaps whether or not you think further action is needed to kind of, to put this to one side?
Well, look, as I said in the previous question, Amy, I think there are a lot of advantages to the investment trust structure, and we shouldn't lose sight of that. I think, I'm sure people listening to it will say, well, you're from Baillie Gifford, you're going to be biased towards what you feel about it. But I think it's very interesting that the independent voting agencies that the institutional investors often use to analyse the proposals unanimously said for all the trusts that the proposal that Saba Capital had made was not in their interest and you should vote against it. So I think that's a kind of interesting one. So it's not just me or my colleagues or other firms affected saying that was somebody independent. But as you said, I think even more important than that was the shareholders coming out to vote. And I think the real surprise for everyone, including Saba, was how private investors who traditionally have not really voted very often, when there was something at stake, they came out to vote and voted overwhelmingly. I think it was at 98, 99% of all people who voted, other than Saba, voted to reject their proposals, which is overwhelming. But the level of turnout was also very good. And I think the skeptics from the industry, were saying, oh, well, private investors don't care, they're not going to bother voting. Well, you know what? They actually got out and voted in a much higher level than people thought. And I think that's a really exciting, point, that actually when people got something they care about, they can do it. And the platforms, to be fair to most of them, made it pretty easy for people to vote, which I think is great for shareholder democracy.
And it's great to see that such an engaged investor base, and that this event has only served to sort of galvanise the community.
Yeah, but going back to your point about discounts, it goes back to the board. The boards have got to be very clear of what they're trying to do, and have they got a strategy, and to communicate that to their shareholders. Trying to please everyone all the time is not easy, and we know that from when I'm trying to invest in companies. You have some people who are wanting the short-term buck, and other people who are generally saying, I want to invest long term, and the investment trust structure allows you to do that. And I think we shouldn't lose sight of that point. That if you look at the investment trust sector, if you look at the kind of comparing that to open-ended OICs, I think there's data from some of the analysts in the city have shown that actually investment trusts for the majority of sectors actually outperform their open-ended equivalents. And I think there are a lot of the factors that I mentioned earlier, the independent boards, the lower fees, frankly, and also the fact that you can gear up with an investment trust, you can use borrowings. If you're positive, that's in the long run, these are all big advantages. So yes, the discount thing is often seen as a kind of millstone for investment trust, but there are a lot of advantages too, and we shouldn't lose sight of that. That's really important, I think, for private investors in particular.
Excellent. Okay, let's move it now on to some of the portfolio activity. At the end of last year, AJ Bell, so sort of staying in this kind of investment territory, AJ Bell was the fifth largest investment in the trust. And but just prior to that, in November, you'd exited Hargreaves Lansdown. So can we do a little bit of a comparison of what's going on here and why AJ Bell is particularly attractive and this area of the investment landscape?
Well, we actually bought AJ Bell at flotation, and we've generally added to our position over time. And we added to it significantly, probably 22, 23, because we could see that the business was really starting to get a lot of traction. Now, to your point of why do you think they were doing better than other people? Well, I think they had the right proposition. It's a good functionality and a very attractive price. They've got a very good management team, in our opinion, that really are focused on both the private investor but also the advisor market. So that's a kind of interesting kind of mixture of what they're trying to do there. But to me, it was just the fact that they did all the right things and they've been investing in their systems. It's just a very well run business, and you're seeing the fruits of that. Hargreaves, it's been a kind of tricky one. Again, we've owned it for a long period of time. For a long time, it was a very successful business. I think, unfortunately, it lost its way a bit and it underinvested. Now, the current management team, I think, were brought in to really address that, and we had a lot of respect for them because they were trying to do that. But it wasn't an overnight story, and it was struggling. And I think there's still some issues there in terms of its pricing and its perception that it premium prices, but is a product really so much better than, say, an AJ Bell? You can discuss that, and I think you look at the flows. AJ Bell is growing significantly faster in terms of its inflows than Hargreaves. And that's really why we wanted to buy it, because we follow the growth. And AJ Bell has been one of the standouts for the last few years, and we think there's still a lot of momentum behind that. So that's the reason why it's one of our biggest holdings, and ultimately that's why we decided to sell out of Hargreaves.
But it's interesting as well, because when you talk about a growth story, I mean, lots of people, there's quite a lot of negative press around kind of the wealth management industry or the future of the asset management industry. There's lots of hurdles that are put in place. But this is here like serving it as a growth stock within your portfolio. So talk to me about the other side of that, I suppose.
Yeah, well, I think you're right. I mean, AJ Bell have been growing in a difficult market with a headwind of the consumers under pressure in terms of the cost of living crisis, and that's been a big issue for everyone in the wealth management sector. That they're seeing outflows of, they're seeing gross inflows, but they're also seeing quite a lot of outflows because people are either having to draw down on their investments to fund their lifestyle. So that's been a kind of big headwind for the last couple of years, 2 or 3 years. But as I said, because AJ Bell's proposition has been so compelling, they've actually been able to grow despite that. Now, I still think longer term, why we still like the wealth management sector is that people are going to need to save for their retirement. So I think even though there's been a kind of short-term, I call it short-term headwind, I think the tailwind longer term is still very strong for the wealth managers, that ultimately people like you and I have to invest to save for the future. We can't rely on the state pension to have a nice, comfortable retirement. So actually, people like the platforms, I think, are really well positioned to do well longer term there. So I think the long-term story is still very attractive. And I think that's one of the things that as a long-term investor, we're always trying to do, Amy, is don't get sucked into the short-term issues. Look at the long-term trends, because they're the things that are going to really dominate, we think, in the long, that'll really matter to the share price. So I still think, AJ Bell's in a long-term growth market.
So it's short-term cost of living crisis, long-term retirement crisis is what you're playing into.
Exactly. Yeah, but the crisis is an opportunity for them. It's not a crisis for them. It's actually an opportunity, and that's that's they're trying to help people. And I think that's one of the other things is they're trying to help people, educate them. Actually, if you don't save, you're going to have a big problem in 20 years' time.
Okay, another interesting holding is AutoTrader. It's second-hand car sales. Essentially, everybody knows the old manual, but this is exciting because it's expanding into new markets, and it's moving into sort of car financing. So, can you tell us more about why this is interesting?
Yeah, well, as you said, it's a dominant player in its market, and I keep saying, when I mean dominant, it's almost like 15 times bigger than the number two player. It is the market. Other people tried to get into the market and they failed pretty abysmally. So that's a great opportunity. But I think what I like about the AutoTrader management team, and Melania and I really, I've gone down to visit them and know them well, is that they're not just saying, "Oh, I can sit in that market and just harvest it because we get the money from the second-hand car dealers." They're also trying to think, well, how can we help that system? So when you say they're getting into the car finance market, that's always been there. But what they're trying to do is to make it easier for the buyer, because often one of the problems for people buying cars is the financing kind of falls through. So they think they found the car on the website, but then they can't get the finance to do it. So what AutoTrader are doing is trying to help that process and take a little cut from it. So they're not lending money, just to be clear. They're just taking, almost effectively a commission by linking up, getting people pre-approved effectively for finance, so that somebody can go into a dealer and say, I want to buy this car, knowing that they've got finance kind of pre-approved, which is good for everyone, but also certainly very good for AutoTrader. And that's just new revenues for them. So it's still very early days in this, but intuitively it looks quite exciting. So that's what we like about the AutoTraders. They're always looking for opportunities to grow their market and use that dominance to kind of actually help consumers. And I think that's a really important point, Amy, that it's always about trying to help the consumer ultimately. You can't force stuff down people's throats. You've actually got to be saying, well, actually, this intuitively makes a lot of sense. This helps me. And that's very compelling economics for a business like AutoTrader.
I suppose it's that kind of cliched idea of having purpose, but you do have to have a real purpose and be solving a real problem, and rather than, as you say, feeding a saturated market with more of the same.
Yeah, I mean, look, Amy, two Brits talking about purpose, we kind of start shifting uncomfortably in our seats because, but actually, if we're Americans, we'd be very happy talking about that. But I think it's really important, if you look at a lot of the attributes of our investments that have been long-term winners, they do have purpose, and it's actually trying to do a really good job for their customers, because that's the thing about capitalism. You rarely have a monopoly, and if you exploit that monopoly, somebody will come in and probably undercut you. So you can't be complacent there. And I think having companies with that purpose is really, really important. And that's why we spend a lot of time trying to get to know management teams and understanding how they think about these issues.
I mean, speaking of purpose, then I want to move on to in the trust you have a capacity to hold up to 10% in private companies, for which you've just got the one holding, which is Wave, which is an autonomous driving kind of outfit, Britain's very own. It's very exciting. It's raised over £1 billion from various backers, high-profile backers, to develop embodied AI products for automated driving. So in layman's terms, what is their purpose, and why is it an interesting investment?
Yeah, well, it's a kind of, effectively, it's a kind of technology, it's a software. So the way I would put it is that probably people have heard about this elsewhere. What other companies, in particularly American companies, have been doing has been almost a kind of rule-based system. So almost they design the kind of, if you're driving along and somebody, you walk out in front of the car, the rule says, you've got to brake hard to stop it. What Wave does is something slightly different. It's almost like a neural network. But what they do is they get drivers in different vans that they have relationships with people like Caddo, where they have cameras and they collect the data. And then the data allows the neural network to understand how a driver reacts to things like, somebody stepping out in front of it. And the reason why I think this is potentially a much more attractive option than the rule-based one is because there's so many variable factors that I think people have heard about the stories about if you're driving along a freeway in California or Texas where there's virtually nobody there, it makes perfect sense, the rule-based system. But if you're driving in Camden High Street where there's kind of basically chaos all around you and people wandering over, that is actually much more complicated for rules. So actually having that kind of intelligent neural network that can actually anticipate what's going to happen, like you and I in real life, you kind of something crazy will happen and you just got to be able to react to that. And that's where the rule-based systems have often failed, is when something weird happens and people didn't expect that and the rule doesn't exist. And the trouble is, if you start creating more and more rules, it becomes this incredibly complicated sort of system, whereas the neural network is actually a much simpler way. But as you said, Amy, the good news for us is we invested in it before that big fundraising came in. We could see the potential for it. But what we're really excited about is other people have now kind of see the potential for this system. And it's interesting, like Tesla are doing something similar. They're the kind of other player in the kind of neural network kind of style of looking at autonomous driving. So it's not just they're out doing their own thing, but the fact that they've got some big backers there that have given them the balance sheet to kind of continue to invest in this product, because at the moment they have no revenue really. So it's very much a very early stage investment, but the potential upside if car companies start to kind of invest in this or want to take this product on is potentially huge. So it's very much an early stage investment, a high risk one. But when we started to do unquoted for the UK growth, we said we want to find businesses that we can't find on the public markets. And Wave is a really perfect example of that. That it's a British success story, we think. Still a long way to go for it, but the potential I think is really is huge, and we're excited about it.
Fantastic. Just to keep onto this kind of technological theme, AI, of course, is a major trend which everyone is getting understandably very excited about. But behind the scenes, beyond kind of autonomous cars and these big ambitions, behind the scenes, it's already worked its way, hasn't it, into the way many companies operate. So like chatbots, automation, and this is starting to provide productivity growth in some of the holdings that you have. Do you want to share some kind of examples of that sort of playing out?
Yeah, I think you're right. I mean, longer term, there's going to be some pretty big, significant things. We don't know yet what they're going to be, but there are already short-term gains. So one example is a company, Howden's Kitchens or Howden Joinery, the kitchen company. And what they did was they put a chat box in for their internal branches to kind of speak to the head office, where the branches will phone up and say, look, do you have this particular piece of stock or this style of kitchen or this color and things like that. And they use AI to basically kind of allow it to kind of answer questions. Now they thought they might take 20% of the questions that kind of come in from the phones to out by using this chat box. It turned out that they take out 60% of the queries from the branches. So, very simple queries could be dealt with very quickly. So that frees up time at the center and also frees up time, frankly, for the people at the branch. They can just kind of fill in the chat box very quickly and they get a quick answer. And that then frees up time to deal with your customers, which I think is really quite good. I think another one is a company we know called Kainos, which is a kind of software kind of implementer for public sector. So, for example, they work with the Department of Transport on the MOTs. So I don't know if you've got a car, you put in the kind of your registration and it kind of tells you whether you've got a valid MOT or not. their technology has helped to digitize that. That what they've used AI to do is actually some of the testing of MOTs. Now, you may not know this, but every mechanic will tell you that the MOT system is actually incredibly complicated. There's huge kind of guides of what you can and can't do. What Kainos have used is to allow the mechanic to speak, effectively talk to their iPad about some query on the MOT, and it will find the relevant section in the MOT handbook so that the mechanic can actually then see it, rather than kind of having to flick through the book trying to find the right relevant section. So again, you can think that actually would save that mechanic a bit of time to actually, get to the issue kind of much more quickly. So things like that, I don't know if that helps you kind of give an idea.
It's like fulfilling the certification criteria then, rather than having to...
There's a question of whether a certain thing can pass the test or not, and they need to kind of check something, and that this thing kind of allows the mechanic to kind of go to the relevant section to say, right, okay, this is what I have to actually do. So it actually helps the mechanic do the MOT better or quicker than perhaps they might have done in the past.
So you get increased velocity of orders or sales, and then you also get more time to focus on strategy, revenue.
Exactly. Or potentially more MOTs, they can do more in a time, because they can actually, if there's anything complicated, it doesn't slow everything up.
With the rise of cryptocurrencies as an alternative to investors, how much of a future threat do you feel they pose to traditional equities and stock valuations? Have you given cryptocurrencies much thought, Iain?
I see them very differently. I mean, what effectively you're buying with the trust is you're buying a portfolio of companies that are generating real returns. They're real businesses making real money, and every day, hopefully, they're making more money for you as a shareholder, which I think is really quite exciting. I think with crypto, in essence, there's a bit of speculation about it, because if it's just a token of money, then you are speculating in money. So I think, I'm not saying you can't make money in crypto, but personally, I'd rather own assets that are generating real returns, rather than worrying about what somebody says on the internet and the price goes up or down. That feels to me more like speculation rather than investment, and we're involved in investment. So that's I'm afraid that's my answer on
very clear distinction. Yeah. Okay, we've got another question here. How long can the trust continue to buy back shares to maintain the discount without losing critical mass and becoming too small to continue?
Yeah, well, it's a great question. I mean, I think our board of the trust, took the view that ultimately we've got to do the right thing in terms of the rating, which is to kind of, get the discount, make sure the discount doesn't kind of, go out. And I think protect the existing shareholders rather than talking about attractive ones. But hopefully the fact that if people can see that the board are doing the right thing, protecting shareholder interest, then perhaps at some point, the discount will narrow. It's gone to premium in the past. And I think that's the other thing that the board, deserves my 5-year credit, that when we went to a premium, we actually issued shares. But when we've been at a discount, we've bought them all back and more. So I think as a board, they've actually done things that have actually helped, long-term shareholders by, managing that demand and supply. But I think longer term, you've got to do the right thing for the shareholders and not worry too much about the size, because I think, we're still, around 300 million of assets. We're still a decent size, so we can still buy back, stock if need be to do that. And I think the board's view is we'd rather buy back the stock than worry about the size.
Well, I mean, we haven't talked very much about sort of the interest rate environment, the macro, and as a result of that, growth has been out of favour. So there is some uncertainty around, how quickly we think rates are going to come back down again. So how does that play into the turning around, I suppose, of the growth story and its ability to narrow that discount?
Yeah, I mean, it's a good question. Again, I mean, look, I think when I think about interest rates, I mean, what is when interest rates have been going up a lot, it's bad news for growth investing in the short run, because people kind of say, well, actually, the future growth I'm going to discount it at a higher rate of return. And that's hurt growth investing, not just in the UK, but basically everywhere. We're now kind of in a cycle where that's kind of starting to reverse a little bit. But as you said, some people are saying it's not going to come down a lot. Now, we're not, as you kind of said, I was delighted the fact we haven't talked about macro, because we're not really a macro house. We're very much bottom up stock pickers. But what I can say is that we've not predicated our investments on the fact that we think interest rates are going to go down or anything like that. What we're trying to do is say, well, we're kind of almost all cap growth and all weather growth. I mean, we want to find businesses that we think can grow through the cycle over the long term. Now, some businesses have got a really strong secular growth story. So something like Games Workshop, I don't think a recession is going to have a big impact on that. There's bigger factors that are going on there. But we also own, some recruitment companies that are kind of cyclical. They are going to be impacted by the kind of tougher markets in the short term. But we think they are great long-term growth businesses, and over this cycle, we think they will grow. So that's why we own them. So I think that's the thing about growth, is there are different types of growth. But if interest rates come down further, that's icing on the cake for us. But that's not our base case for why we own our growth investments. We just think that our portfolio is going to grow faster than the market in terms of its earnings, and you'll be rewarded for that. If you're re-rated on top of that, that's great, but that's not our base case.
What allocation will you be looking vis-a-vis private equity UK going forward? They've mentioned Hargreaves Lansdown. Would you consider adding similar turnaround plays in the future?
Yeah, well, as you said, we've got about 10% limit on privates. We've only done one investment. Melanie and I have been quite picky. We're just wanting to find the best of the best. So it's very much to the question. It very much depends on if we can find the right opportunities. Then we're not going to be frightened of doing them. But we want to find businesses we think we can make, very good returns for, and if we don't do them. So it's very much on a case by case basis. But so far we found one which touch wood has started off quite well for us. But it's still early days. But we're always on the lookout for other things. But at the moment, we're still like what we can find in the public market. So we don't need to have private investments, we think, to generate above average returns. Just to be clear, we still think there are lots of these companies that we own we're really excited about, and we think they are great businesses.
And do you think this, as we loop back to the beginning where we talked about the UK being out of favour, deeply unfashionable for some time, that has broadened the opportunity set and the ability to invest at pretty good valuations?
Yeah, I mean that's what we've done. I mean we don't trade a huge amount, but what some of the things we've been doing is effectively recycling some of the capital, either for things that have been taken over, and buying into companies which we think the market, adding to positions that we think the market is underestimating the long-term potential of them. And you see that. But what I'm encouraged by more recently, Amy, is the fact that we've gone through, you think about the last 5 years, we've had the pandemic, we've had this, as you said, interest rate cycle, we had the inflation shock. We're starting to see a little bit more about, it's starting to normalize a little bit more, and the market then is starting to reward companies that are delivering, above average kind of growth. And last year we saw some, really good, nice share price movements from companies, like AutoTrader or Just Group, the annuity provider, where they delivered really good numbers, and the market, responded very positively to them. Now, what we've been puzzled by a little bit before, particularly something like Just Group, was they've been doing it for a number of years. But last year, perhaps because there's less noise now, you could actually say, this business is doing really well, and actually the shares are far too cheap. So that's good news for us, is that the fact that people are now looking at fundamentals again, rather than the macro stuff that probably dominated over the previous few years.
Okay, we've got a question here more about sort of, I suppose, portfolio construction or asset allocation. Why do you think UK-specific growth companies warrant a special place in investors' portfolios against the broader opportunity set available in growth companies around the world? So I suppose why a UK-specific growth story versus a broad growth?
Well, look, I mean, I'm sure some of my colleagues who run other trusts in Baillie Gifford will be watching this and how I answer that one. I mean, I think growth is a very attractive area. What I'd say about the UK is the fact that you find a lot of business, you've got very good governance. I think which is one thing that I think people do kind of moan a little bit about, red tape and bureaucracy. But actually, fundamentally, the UK is a very good place for shareholders to be well protected in terms of companies taking interest in taking their interests account of that.
This Saba episode is really an example of that as well, isn't it?
Exactly, but even more broadly, what I was meaning more is in terms of kind of companies, underlying companies, in terms of kind of the governance structures, the fact that really shareholders are kind of generally pretty well protected in terms of management and boards doing stuff that not in the long-term interests of investors. But I think on top of that, when you have companies that are willing to grow, that take that long-term view, I think it's a very powerful combination of good governance, but also that underlying growth that you can find in the UK. And almost going back to one of your earlier questions, Amy, is that we find that particularly in the kind of mid market and smaller market, those kind of companies that perhaps people haven't heard of as much, but I think long term have got that really exciting potential. So it's not the likes of BP or HSBC. It's companies like Kainos or Creo Medical that people have never heard of, but we think are actually got very exciting kind of long term potential.
Okay. We've got somebody here who wants to delve a little bit more into the AJ Bell story. With profits coming from interest margin, is the degree of AJ Bell's profits coming from interest margin a concern? How will fee-based income grow to catch up with this and make up a greater portion in the future? Does that make sense to you?
Yeah. Yeah, no, I mean, so I mean, basically, AJ Bell make money from a variety of factors. One is, as the questioner said, is from the fees that they get, or the underlying ad valorem fees. So you get a small percentage of your assets. So obviously, if the assets go up over time, the stock markets go up, then that fee income will go in. So that's a very attractive long-term attraction for the business. But they also make a spread, as the questioner said, on the cash that's held on it. Now, let's be honest about it. That's what banks do. So this is not something that this is some unique to platforms. So the fact that some people have been griping about it is the fact that actually banks have always been doing that. So AJ Bell aren't doing anything particularly different. What I think was kind of interesting was the fact that a few years ago when interest rates were at zero, you couldn't really make much money from it. But the fact that interest rates went up, then there was a spread that was available now. Now, as interest rates go down, do you think that spread will kind of probably come in? Yes, it will. So I think the questioner is right. There will be a bit of a headwind from that. But against that, you're getting inflows. The markets have been going up. I still think it's a growth business. So but these factors, these short-term factors, have always been kind of occasionally go against you, occasionally go for you. But the long-term trend has been positive, and I think that's why we still like it longer term.
So we go back to this kind of point about interest rates being okay. You can weather it. You might be winning from it one day, losing another year, but actually the long-term trajectory is the fact that everybody's got to save more, because otherwise we could have a retirement crisis.
I mean, yeah, exactly. But I mean, I think there's a danger that people anchor off the very low interest rates we saw, after the great financial crisis. If you look at the really long term, and I'm talking like hundreds of years, that is the exception, not the norm. And there's a danger that people sort of assume that what happened a few years ago, that things are going to go back to that level. I think that's unlikely. I'm not a macro forecaster, but I think it would be very, unless something's gone really wrong with the global economy, it's unlikely that we're going to see those rates again at virtually zero or negative rates. I mean, I just don't think that's likely. It might happen, but it'd be the exception, I think, rather than the norm. And I think that's, you got to think about that. So that's why I think banks and people like the brokers making a spread on people's cash, I think that's part of capitalism.
But I mean, it's funny the point that you make, because if you look at how we got to such low interest rates, 2008. So now we're 17 years later. We haven't really experienced interest rates that have been anywhere near kind of what they were at pre-crisis levels. So like nearly 2 decades is quite a long time for people to get used to kind of that being the norm.
Well, I mean, I'm sure my age, Amy, but I remember my first mortgage, it was about almost 9% was the mortgage rate, which seems kind of astronomical now, but that was the market rate at that point. So, I think there's a danger that people forget history. But the other point I think we should say, to be fair to AJ Bell, is that their rates of interest that they're charging on cash is probably a lot better than a lot of the high street banks for their kind of mainstream accounts. So it's not as though they were offering nothing. And I think one thing about regulation and consumer duty is it's really forced the providers, the platforms, to justify why they're earning what they do. And they put a very robust set of reasons why they think it's a fair combination of actually paying a pretty decent rate of interest, but they're making some money on top of that. And and so far the regulator seems to be quite happy with that.
Okay. All right, we've got the last few minutes left. Our final question is around, so you've emphasised the importance of cultural adaptability of the management teams you invest in, especially in a rapidly changing world. So could you share how you evaluate those characteristics when you're departing with capital to invest?
Yeah, I mean, a good example of that, I think, is Just Group, the annuity provider, that originally their business was individual annuities. And then you may recall, almost a decade ago, George Osborne, in a budget, everyone's shocked, said you don't have to buy an annuity anymore. So suddenly their market just changed overnight, that the bottom fell out of it, and they had to adapt. And what they did was they still write in individual annuities, but they had to move into the bulk annuity market, so the kind of corporate pension schemes. So they had to retool their business effectively to find a new market, and they did that and they've done that very successfully. On top of that, they then had kind of a regulatory shock that one of the assets that they used to kind of hedge against the annuities, which is these guaranteed mortgages. The regulator said, well, we don't really like them, or you owe too many of them, they're too risky. Although I think I and the company and others in the industry disagreed with that, they had to adapt again the assets that they hold against annuities. And again, they have adapted to that and are actually now thriving. So that's an example of a company that had that worst nightmare that a politician almost overnight decimates your market by saying one standing up, and then they've actually are thriving now, and are the share price is higher than it was at that point. So that's an example of to me of adaptability. Now hopefully we don't get too many of those, because it's been a pretty long journey for Just to get to that
slightly position. Stressful.
Yeah, exactly. It can't have been easy for the company at the time, but that's what you want. And I think that's one of the X factors, Amy, that you don't see in the companies that we're trying to invest in, is companies that do have that adaptability, that people are trying to look around the corner to see, well, how can I find growth in the future? Not always going to get that right, but having that mindset, I think, allows you to capture those opportunities that everyone else hasn't seen yet. That's exciting.
What do they say? Necessity is the mother of invention. Is that the saying? It feels like that's
exactly.
It feels like that's what Just Group kind of is. It's got its purpose through the necessity to survive.
Exactly, and actually sometimes patience as well, because the interesting thing is individual annuities are growing again quite strongly. So people are actually seeing there actually is a benefit of higher interest rates to actually having an annuity again. So what goes around comes around again, somewhat.
Yeah, and I suppose that's testament to having a relationship and kind of knowing your company as well.
Yeah. Well, actually, that's one point where regulation is actually working in their favour now, because I think consumer duty is forcing advisors, I'm sure people who are listening to this know that, making sure that their clients have, a kind of, not necessarily guaranteed income, but kind of how they're going to support themselves. And then that suddenly, annuities suddenly seem a pretty good idea after all.
Okay, right. That's all we've got time for. So I'm afraid, thank you, Iain, for your time and insights, and thank you for watching and for your questions. We have more sessions like this coming up, so do keep an eye out for those if you found today useful. Thank you very much. Thank you, Iain.